I think you're going to see more margin erosion and therefore an accelerated move to substitute capital for labor. And we've been doing a lot of work on automation and AI and analyzing how important that will be to the future. Just one other note, since I've just said that, I know that robotics scares a lot of people. Automation, AI, they think about job losses. And in the short term, yes, there's displacement as we figure out new and more efficient ways of doing things with technology. But the history of technology is that it is a net job creator over time. So I never worry about that. And the easiest illustration, of course, is what happened when we started to automate the farm. And so with that, I'll start going through the charts. Typically, we do fiscal policy, monetary policy, economic indicators, and market indicators. And we'll do something like that, but it will be in the context of the letter I just wrote. So we'll start with the first slide here. And this is a very important slide. It illustrates the Laffer curve. When you cut taxes, if tax rates are too high, then the revenue actually will increase. Why is that? Because companies and individuals stop using tax shelters and stop trying to avoid taxes. I didn't say evade. That is illegal. I said avoid, figure out ways around the tax system. So here you can see the history of the corporate tax rate. And that is the black line there. And you can see over time what has happened. This goes back to the early 1900s when we first put in place various income tax rates. And you can see there wasn't a good recording of tax receipts until the late 40s. But you can see how low the tax receipts were in the low 40s, how much tax rates have come down over the last 60, 70, 80 years, and corporate tax receipts going to all-time highs. And that's because lower tax rates do tend to stimulate growth, and there is less tax avoidance. You can see in the last Trump term, the corporate tax rate went from something like, well, I guess the maximum corporate tax rate went from 39%, and the average went from 35% to 21%. And in Congress, many people did not want that to happen because they thought that our deficit was already out of control, and this would make it worse. As you can see, tax receipts are up from the 2019 from roughly $200 to $500 billion. And of course, there was the COVID setback there, but so that somewhat distorts it. But tax receipts are up since we cut tax rates. And we think that the same will prove true with individual tax rates as well, especially, and I know this is politically sensitive, but the top marginal tax rate, if that were to come down, a lot of very high net worth individuals would stop using tax shelters. It just wouldn't be worth the legal costs and all of the complication. And so I wanted to show this chart because the chairman of the House Ways and Means Committee, which is where tax proposals start, he mentioned what has happened to the corporate tax rate as as a setup for what they are going to propose in this budget. Now, President Trump and this administration generally would love to get a tax package and a budget put to bed by July 4th. I think that the Senate is thinking more like August. The House is thinking they can get something through in May. And I think that President Trump and his team are going to work aggressively to get something done by Independence Day. Lots of symbolism there. And so we'll see what happens. Stay tuned. One of the reasons we think that the odds of a tax package and a budget are increasing by July 4th is we're seeing some weakness in the economy. The GDP numbers came out this week, and we had the first negative quarter since the first quarter of 2022. And so I think the heat is on a little bit politically because we are heading for midterm elections before we know it. The campaign season seems to be already underway, but officially we won't see serious campaigning, I think, until later this year and into next year. Nonetheless, we're in a hot political environment, and economic weakness will hurt the incumbent party. So I think that President Trump, the Republican Party, will really want to get something through as quickly as possible. So now we're going to go through some of the charts that I present in the letter. And the setup for the letter is the rolling recession that we've been in. Now, many people just don't understand what we're talking about when we say that. But we illustrate that we have been in a rolling recession. And now that we're seeing real GDP turn negative, it did so in the first quarter. We may see much more in the second quarter because we're hearing from a lot of companies during earnings season a little bit of a seizing up in spending behavior, some paralysis, waiting to see what happens with the tariffs and with the budget. So I think we'll hear a lot more talk about recession. And what we tried to show in the letter is, while many economists and strategists might be talking about the beginning of a recession, we think that the final two sectors to give way, those that have been holding up the economy for the past 3 years, providing us with positive GDP growth overall and employment growth, importantly, those are capitulating. They are the high-end consumer and government, the first government recession in the last 30 years. The last time we had government contract was during the Clinton administration with Newt Gingrich leading Congress towards more fiscal discipline. And so here we go. Now, one of the reasons we talk about this rolling recession and have been so vocal about it for the last few years is this chart, the Fed funds rate. And you can see it is just starting to tip over after hitting essentially the same level that it did in 07-08 before the great financial crisis. The more important part of this chart, this is the rate of change in the Fed funds rate. And in a 16-month period, in 22 into early 23, the Fed raised rates 22-fold. And that's what this shows. In 16 months, 22-fold. This has never happened in history. We go back to the 70s here, or through the 70s here. But if you take the history of the Fed funds rate back to 1913, you'll never see anything like this. And many people have dismissed this logic, saying, oh my gosh, we were starting from 0.25%. It was such a low rate. this really doesn't matter. It was such a low rate, yes, but from from 07, 08, 09 until this massive increase, the world had gotten used to, and especially the United States, to very low interest rates in terms of decision making. If we look at what was happening in the 70s, over time, you can see that people were getting used to interest rates rising, inflation rising, and they were adapting accordingly. There were a lot of inflation expectations built into decision making. There are a lot of interest rate increases built into decision making. That was not true this time around. So this was a real shock, and we believe it started the rolling recession. And we'll get into what that rolling recession looked like. But before we do, just on monetary policy to finish up, the velocity of money is the rate at which money turns over. And you can see it has been in a declining trend since the late 90s, which was the tech and telecom bubble, and which unleashed a lot of technology that over the ensuing 20 to 25 years have been deflationary in nature and helped to hold inflation down over all those years. And then, of course, we had COVID, and we had an absolute collapse in velocity because everyone thought the world was going into depression. So there was an absence of spending. And then, of course, we had massive fiscal and monetary stimulus coming out of that, which stimulated not only the growth of money, but the velocity of money. But if we're right, the velocity of money is going to tip over here again. In fact, it already has sequentially. It dropped in the first quarter. It was fairly flat sequentially in the fourth quarter. And as you can see here, it's at about 1.4% on a year-over-year basis. I think that's right. But dropping sequentially means that there's going to be pressure on the year-over-year number, which will pull overall velocity down. That's a real break on economic activity. And so the Fed does not have much room to maneuver here. The market is beginning to understand this, and it now sees roughly 4 cuts, I think, this year in the Fed funds rate. Now, what did that very sharp 22-fold increase in interest rates do? This is what we're talking about when we say rolling recession. It shut down home sales. You can see, and the actual number, peak to trough, existing home sales dropped 39%, and they really haven't recovered. Why is this? Well, of course, people are trapped in their homes with 2 to 3% mortgage rates. If they rolled into a new home with higher prices, because prices have increased during this period, their mortgage rates would double or triple, and in some cases quadruple. They can't afford to do it. So housing has been in a recession. Auto sales. So autos are a pretty mature category. And here you can see auto sales after the bump during COVID. Autos were hard to get, production stopped. They flatlined in the 15 to 16 million range, which is subpar relative to past cycles where they flatlined closer to 17 to 18 units. You can see very recently they had a pop. What is this? This was pre-tariff buying. And according to auto analysts, we're beginning to see the unwinding of that now that tariffs are in place. And some of them actually are being taken off. So we have auto analysts expecting this number now to drop back to the 14 to 15 million unit pace. So that will be a drag on activity in the second and third quarter. Look at what happened to manufacturing in the U.S. The spike in interest rates in 22 drove manufacturing down. Now, this is a diffusion index. So 50 is the demarcation point between expansion and contraction. And you can see we've been contracting since then. Manufacturing has been in a recession. And when we say rolling recession, housing and manufacturing never got out. They've stayed down. Then we can go to capital goods. Capital goods, likewise, those decisions, even with AI and all of the power investments, so data center and power investments that have been booming here over the last few years, even with those, we have been nowhere. Capital spending, broadly based, has been flatlining for the past few years. Another form of rolling recession. Here's what's happened to small business. So this is their optimism index. And you can see as interest rates went up dramatically in 22 and early 23, the small business confidence collapsed. And look where it landed. It landed below COVID lows and closer to where we were in 08, 09 and coming out of 08, 09 as the world seemed like such an uncertain place. The big spike here was the election. In the election, NFIB optimism boomed, but now it is unraveling, and we'll get another reading in mid-May. And according to some estimates, the small business optimism index is back to where it was with the increase in interest rates. Why? Of course, tariff confusion and chaos, and credit conditions tightening even more. Now, they were tightening for small businesses all along. They just couldn't get credit. And once again, now that credit spreads more broadly, and I'll show you this later, are gapping out, the credit conditions have become very difficult once again. And then here, this is certainly some drama, another sentiment index. Here you can see in 22 and especially, you saw the collapse in confidence, and it was all three income categories: top third income earners, bottom third, and middle third. They all collapsed at the same time. You saw the low income earners really never recovered. And look where we are again, below COVID and where we were in 08, 09. Actually, low income earners' confidence today is below where it was in 08, 09. And you'll notice after a little bit of a rebound, and certainly the high-end consumer performing well, in April, we saw the high-end consumer sentiment. Again, the high-end consumer had been holding up consumer spending. It came down dramatically. Again, I think the stock market turmoil was a big reason for that, and it is probably hurting spending now. And look at how low this is. You really do have to go back to 08, 9, 10, 11, when the consumer just was. And remember, this is as GDP is not contracting, except for that half a point or a third of a point in the first quarter. And employment hasn't collapsed. This last employment report, when you include the revisions, was a little better than expected. Again, this hoarding of labor, but the consumer isn't feeling really good about this. And then just to give you another peek at what the consumer is thinking about business condition.